What's up, guys? Welcome back to another video. Rope Monster coming at you here from the office in beautiful sunny Playa del Carmen. Happy Halloween. It is the 31st of October. Yesterday was a blast. We had a subscriber meetup at Ceviche Corazon, a Halloween costume party. But guys, a number of you at the get-together expressed some disappointment that I haven't been doing the financial retire early investing type videos that I used to do quite frequently. And so today I'm bringing you that content. And keep in mind, guys, this is not financial advice. I'm sharing with you what I'm personally doing, how I'm positioning my portfolio in what I think is potentially the biggest bubble since the dot-com bubble. And people are calling it the AI bubble. I tend to agree that valuations, the S&P is at all-time highs. Some of these tech stocks are flying high. Now, guys, that's not to say I don't own tech stocks and I don't like tech stocks, but I haven't been buying any tech since the tariff sell-off in April. I was buying a ton of Google, and we all know that has worked out well. But guys, let's dig into it. I want to tell you exactly what I'm doing with my portfolio. If you appreciate my efforts, just smash the like button for me. Subscribe if you haven't already. Let's dig in. So guys, I was buying Google, like I said, during the tariff sell-off, and I think it was a fantastic buy. There was a lot of worry about ChatGPT taking away from the search engine. And since the lows of early May, Google is up 79.9%. And I think it's slightly overvalued. I think it's a great company to own long-term, and I'm very glad that I bought those shares. But I think with some of these stocks running up over that period, we have to look at maybe some stocks that have been out of favor. And why is that? Well, yields have been pretty high, but the Fed just cut rates again for the second time in the year. And so as rates dip below 4%, people are going to need to look for that yield elsewhere. The bonds aren't going to yield that, the T-bills. And so you'll have to look at defensive dividend-paying companies. And what I've been doing, guys, I'll get right into this, but I want to highlight just a couple more stocks and how they've performed in that same time period. And these are great companies, no doubt about it. But let's look at NVIDIA over that time frame is up 87.5%. A lot of these stocks have just gone bonkers. And good on you if you're buying them at those lows. But these do not offer yield. They don't offer cash flow for people like myself who are already in retirement. And so what did I do just now in this moment? I'm going to share a few different stocks that I've been focusing on. One of them is General Mills. Just moments ago, and I'll potentially put that up on the screen, I sold multiple cash secured puts on this company. It's trading down in the $46 range. Morningstar has a fair value estimate of 60. The dividend yield is over 5%. And I think what will eventually happen, once again, this is not financial advice, but I think when tech starts to sell off and this bubble bursts and people start coming back to reality and looking for yield, the money will generally find its way into these dividend yielding equities like General Mills. And I just got paid a pretty nice premium on the put options. I was able to generate some cash flow just on the options. I sold the put at $47.50, which means if it hits around the $45.50 range, I'll be assigned those shares. And I'm completely fine with owning General Mills. This is the second time I've owned this company. Next, I want to dig into the brand portfolio on General Mills and why I bought it. It's not for the cereal, guys. Spoiler, it is not for the cereal. All right, guys, so this is the second time I've owned General Mills. I was buying it back, I think, in 2020 and 2021 in the mid-50s, $56, $58 range a share, and it's trading about $10 a share cheaper than that. So I'm familiar with the company, but some of you may not be. You might think, okay, they've got Lucky Charms, they've got Cinnamon Toast Crunch. Actually, what interests me more with this company is the snack foods that make up 21% of the sales mix. Actually, the biggest amount of the sales come from snacks, but also the fast growing organic and natural pet food. They actually own Blue Buffalo. Many of you dog owners are familiar with Blue Buffalo. Well, let's go through some of the brands. Annie's Mac and Cheese. They've got Bisquick. They've got Bugles. Of course, the cereals, Chex, Cheerios, but they have the Cascadian Farm as well. So like the more healthy on-trend cereals, Cinnamon Toast Crunch, Cocoa Puffs, Cookie Crisp, all that stuff. But then they've also got the Epic bars. This is where the snacking comes in big. Epic is like just pure meat. They have salmon, they have venison. So I really like what General Mills has done here with the snacking. And they also have some prepared meals and things like that that don't excite me quite as much. They do own some ice cream. They own Haagen-Dazs, and so I love that. They've got Nature Valley, which holds a huge place in retailers' hearts because they know it's going to sell well. So Nature Valley has that premium shelf space typically and a huge market share when it comes to snack bars. You've got Pillsbury, so these brands tend to be very defensive. And so that's the brand. We all know Wheaties. That's the brand portfolio. So I won't bore you with the entirety of their portfolio of brands. But they're market leaders in multiple areas, including dog food, including snacks. So keep that in mind. Now, I think that Morningstar has a fair value of 60. I came up with a fair value estimate of about $63. And so if you're buying it at 45, you've got conservatively 25% upside on the shares, plus that 5+% dividend yield. That gives you a potential for a 30% return when it reverts to fair value. And in the meantime, I'm happy to collect that 5% dividend. The dividend is well covered. The payout ratio is only, I think, 45%. So guys, that's General Mills. Let's dig into some other companies that interest me right now. And spoiler alert, they are defensive and they are consumer staples. I'm positioning my portfolio for a big pullback in AI and a push into high yielding dividend stocks of high quality. And so guys, the operating margins for General Mills are, I think, 15%. The return on assets is very, very healthy as well. Let me get into Yahoo Finance and just give you a couple numbers. The big one I always look at is free cash flow. Is the company cash flow positive? So we've got profit margins of 15%, return on assets of 6.2, that's decent. Return on equity over 30%. Now here's where it gets interesting. We've got levered free cash flow of $2.12 billion, operating cash flow of $2.7 billion. So the dividend is well covered. What you have here and why this is interesting is the 5-year average dividend yield is 3.35%, and it's yielding over 5.2% right now. So you're getting a premium quality company with a well above average yield compared to its 5-year average. That will pay you while you wait for that 25 or 30% return. Keep in mind, guys, this stock has traded well over $80 a share. I sold out in the high 70s and the low 80s when I first owned the stock at about a $58, $59 cost basis, and I did very well on it. And I would be happy to own it again. I don't yet own it again, but I sold the cash secured puts on it. So if it hits a certain price, I will be assigned more than, well, let's say a couple hundred shares or so. And so that's my strategy there. Let's dig into the next stock, guys. So one last note on the actual options trade I made on General Mills. For those of you interested in that, please do your own research. If you don't understand options, you're better on the sidelines. If you do understand basic option strategies, I will say this. I sold the put at $47.50, the November 21st expiration date. And so some of the Greeks on that, the implied volatilities at 27, which is fairly high for General Mills. The delta is at 60. So there's a pretty high likelihood of assignment there. Do not sell that put option unless you actually want the shares. I want the shares, but I wanted to get paid to buy them. So that's the last note on General Mills. Company number 2 that I've been outright buying and also selling puts on, forgive me guys, I've got the sniffles. I'm doing an oregano oil sinus cleanse, not medical advice, but it seems to be draining my sinus issue pretty well. But guys, Clorox company, once again, this company surprises with the brand mix. Once again, we're in that pet space. They've got the Fresh Step kitty litter and pet products, and also Hidden Valley Ranch, Kingsford barbecue products, commercial pool products. We all know they have the cleaning and household products as well. So look deep into the brands, but once again, you're getting about a 4.3% yield or 4.4% yield, much higher than the 5-year average. It's a very defensive, high quality company. I would say even higher quality than General Mills. Consistent return on invested capital of 20% or more. Return on assets of around 13%. That's a really high ROA, guys. And this is the cheapest the stock has traded in the last decade. And I think there's a major disconnect there. The stock is out of favor because 2026 earnings will be a little soft. But looking into 2027 is where I'm at with this stock. My holding period is probably 2 years. And once again, you're getting that dividend while you wait. And I think if we look at potential upside to fair value, say to from these levels back to about 140 or 150 a share, you're looking at close to 40% returns plus the dividend. Once again, not financial advice, but this is how I'm positioning my portfolio. I think if and when tech sells off, which is inevitable, there's got to be some type of correction. Money will find its way into the Clorox company and shares will not necessarily skyrocket, but they will revert to fair value of around 148 to 158. I'm fine with those kind of returns. I think there's very little downside risk. That's just my opinion. And I get that nice dividend while I wait. So those are 2 companies that I've actually been selling puts on, and I'm willing to have quite a substantial position in both General Mills and Clorox in my portfolio. I also own Campbell's, full disclosure, and I've been looking again at PepsiCo as it's dipping back down. I was buying PepsiCo during the tariff sell-off under $130 a share. That's a fantastic company that needs no introduction. And I think Kimberly-Clark is on the list as well. It's a high quality company. I know a lot of funds are buying Kimberly right now. Toilet paper, Kleenex, all those household staples that you really can't live without, that really can't be disrupted by AI. So those are companies I wanted to mention, and I'm positioning my portfolio to be very defensive and to be cash flowing. I want those dividends. I want the options income. So guys, that's what I'm doing. Just a brief update today. Honorable mention in a different sector is Nike. I think Nike is still worth selling the occasional cash secured put on at these levels as well. Although I have already a substantial position in Nike that I built during the tariff sell-off in the mid 55 area. So hopefully you guys found that useful. Once again, consult a licensed financial advisor before making investment decisions. But this is what I'm doing with my portfolio. Please leave in the comments, what are you doing right now investment-wise? What stocks are standing out to you? I did have one person in the live stream the other day when I mentioned Kimberly-Clark say, I didn't know you were a boomer. Well, I'm not a boomer, but I am retired and I have a very low risk tolerance. So paying sky-high valuations for Tesla or Nvidia is not in the playbook for me. If you're a young investor at 20 years old and you want to hold these companies for 30 years, you'll probably do just fine no matter what price you pay for Nvidia. But that's anyone's guess. So anyway, guys, I'll see you in the next one. I've got to prepare for this Halloween Dia de los Muertos parade. I'm going to go film that. I'm going to hand out a bunch of candy to the kids here in Playa. And so that is very important to me to be a part of these festivities. With that, I'll leave you. See you guys in the next one. Thanks for stopping in. Smash the like button for me. Subscribe if you haven't already. Rope Monster, out. So guys, it wouldn't be a Rope Monster video without some bonus material. So I'm going to leave you with some numbers on Clorox and then one other aspect of how I invest personally regarding being a contrarian. So we'll dig into that in a moment. But Net margins for Clorox right now, 11.4%. Return on assets, 13.1%. That's an incredibly high ROA. Revenue growth for the quarter, 4.5%. Quarterly earnings growth, 53%. The balance sheet is decent. And once again, levered free cash flow of over $1 billion. That's pretty good for a $14 or $13.5 billion by market cap company. Then we look at the dividend, 4.4% yield right now, 5-year average yield of 3.08%. So we're getting a premium there. And guys, one stock I was buying last year was Huntington Ingalls. I mentioned that in a video. HII is the ticker. Look that one up and see how it's done over the last year. Now, aerospace and defense was out of favor during the election time when a lot of people thought the president in the US was going to be Kamala Harris. Aerospace and defense sold off, and then Trump has since reiterated that he wants to build a stronger Navy. They're partnering with Hyundai Heavy, which is a shipbuilding unit from Hyundai. And that stock, I've gotten a 70% return in exactly 1 year, plus the dividend. So Huntington Ingalls has done well. I bought it when it was out of favor, and it actually dipped even further from where I entered. Last February, I added to the position under $160 a share. Yesterday, it actually hit all-time highs, I believe, of $328, $329 a share. Fantastic returns by going against the crowd, going against the grain. And right now, I think consumer staples is a perfect example of being a contrarian investor. Everyone's buying these tech stocks and paying sky-high valuations. I'm buying the boring, stodgy General Mills, Clorox of the world, and even Campbell's. So there you have it, guys. That's just a little bit about my strategy. Contrarian all the way. As long as the fundamentals of the company are good, I don't care if it's out of favor and it's the least talked about around the water cooler at work. There you have it, guys. Now you know. See you guys later on.